Welcome back. I want to recap a number of different big numbers that were released last week and also talk about the technical picture as far as the market's concerned. It may be obvious, but I think it really is worth stating because the market definitely has decided on a trend, at least for the near term future. First off, durable goods were released 1.7% versus 1.2 prior. That's an improvement. Durable goods is a measure of those products that are designed to last more than 5 years, like dishwashers, appliances, things of that nature. That's somewhat linked to the housing market as well. It's a positive sign. Durable goods ex transportation, not including transportation, 0.6 versus a prior negative 0.6, and that does not include transportation such as aircrafts, which is actually more directly linked to the housing market. Gross domestic product, the revision is at 2.0 versus a prior 1.3%. And PCE, personal consumption expenditure, which is a measure of inflation, 3.8 versus a prior 4.3. So we spoke about this last week in terms of the Federal Reserve's dual mandate. There's three points that they do focus in on: stable prices, maximum employment, and a moderate level of inflation. Now, if we look at it from all three points of view, stable prices, PCE, personal consumption expenditure, inflation is dropping. That's a good thing. That gives the Federal Reserve more reason to raise interest rates. Durable goods rising, also ex-transportation also rising, GDP revised up. That also gives the Federal Reserve more reason to raise interest rates. The real question that everyone is asking is the Federal Reserve going to raise interest rates after pausing? Well, at least according to these numbers, it does give them reason to do so. Very quickly, let's run through a couple charts. This is the durable goods versus S&P 500. Durable goods, this reflects all durable goods in green, S&P 500 in yellow. Both are trending to the upside, obviously, after hitting a very big low back in 2020. These two numbers tend to have a very strong correlation. As durable goods goes up, so do stocks. This is durable goods excluding transportation, which is more directly linked to the housing market. That's in green. Manufacturers' new orders, that's in green. Durable goods ex-trans, that's in yellow. Both are trending to the upside. Not a big divergence, which tells us that it's not as if the transportation component of durable goods is really affecting this number very much. It's much more broad-based. Same holds true for durable goods. In yellow, that's ex-defense, not including defense stocks or the defense component of durable goods, versus the overall durable goods in green. Both are trending the upside. It just shows us that there's not a big divergence between those durable goods created for defense or transportation and the overall index. This is durable goods only in defense in yellow, actually moving a little to the downside as the green S&P 500 moves up. This is durable goods versus the personal consumption expenditure component of durable goods. PCE is in green. PCE related to durable goods is in yellow. Again, not a big divergence. Overall, all these charts are telling us the same story. Here's a transportation segment of durable goods, which is actually very strong versus S&P 500. It shows us there's a broad-based improvement in the goods that are produced that are meant to last more than 5 years. Washing machines, appliances, transportation products, defense products, computers, electronics, things of that nature. Here's a comparison of durable goods versus Whirlpool stock, which they manufacture appliances. Now, Whirlpool's been weak, and we've spoken about this. We're going to revisit this actually in the near-term future as well. The difference in the different performances of the indices, S&P 500 versus NASDAQ, Dow, and Russell. There is a very big difference. Whirlpool is part of the overall S&P 500. S&P has not been doing well this year so far. The NASDAQ has been doing a lot better. And this is a theme that we're going to touch upon in the days and weeks to come, is the divergence between the numbers and the S&P 500, which is probably the best broad-based reflection of our economy, is the S&P 500. The Dow is only 30 stocks, so it's a very particular selection. But the numbers look good, like the durable goods we're talking about. But the stock market, the S&P 500, does not look so good. The NASDAQ, which is much more technically weighted, it looks a lot better than the S&P 500. If you're not in tech stocks, you're probably not making a lot of money this year. This is a quick look at the PCE, personal consumption expenditure. That's in yellow at the bottom. That's really kind of flat, not trending up, which is good. We don't want inflation to go up. The blue area chart is CPI. Now the red line is CPI versus PCE. When CPI, Consumer Price Index, rises more than PCE, the red line goes up. The red line's kind of flat, and it almost looks like it's wavering a little. It's definitely not trending higher. Now, what's the difference between CPI and PCE? They both measure rates of inflation. There are a number of different distinctions between the two. But to summarize, the PCE it's a more comprehensive measure of inflation, but it includes Medicare, paid for by employer, provided insurance. It measures the change of prices in goods bought by households by the government on behalf of households. So those government programs are much more accurately reflected in the PCE. CPI, Consumer Price Index, it measures a basket of goods and services such as food, housing, transportation, healthcare, but that more accurately reflects the consumer government program, so to speak. So if we were to ask, for example, how does this affect us? Well, as the average consumer, we would want this red line to go down, which means that the price of goods and services for the average consumer that does not participate in a lot of government programs, like Medicare, Medicaid, that sort of thing, that would be good for us if this red line goes down, because it means the cost of goods and services for the average consumer that's out there, in the economy, participating in the economy, that those prices for us are better. And there's a lot of other intrinsic differences as well. PCE also allows for substitution, where CPI will measure the price of a steak. PCE will say, well, if we don't have enough money for a steak, we'll buy chicken. And then, the price of chicken is less than steak. So the CPI is more of the standard measure. The PCE more has an understanding, so to speak, about, economic differences. And that line is kind of wavering, going down, which means that prices for the average consumer is going down, but not really going down a lot. It's just not going up anymore, at least over the past couple months. So I don't know that there's a lot more that we can take away from this. But with that said, let's get the GDP, gross domestic product, which was revised ever so slightly higher. That's reflected in red here as the staircase perpetually marches higher. The purple line is the S&P 500, which had a significant downturn 2022, but seems to be really marching higher. This is the GDP per capita, per individual, versus the S&P 500. Now that's kind of remained flat. So the overall GDP is rising, but not necessarily per capita. We could probably look into this to see for the difference, but the chart pattern is very, very similar. This is household debt to GDP. Household debt to GDP, the ratio is in purple. The green line is the S&P 500. It would be troubling if this line were to begin to rise. We want to watch, and we're also going to start watching debt levels pretty closely, because if debt really starts to rise and credit card debt really starts to rise, some measures show it has risen, others have not. That is a troubling sign. That's something we saw in '07 and '08. So far, that's not the case here, but it's not exactly going down either. It seems to have kind of leveled off at a place where we haven't seen a change since September of 2022. That is a little troubling because we'd like to see household debt continue to go down, especially if we see durable goods go up and the GDP go up. Why is the household debt to GDP not going down? And this is, of course, GDP versus the federal funds rate. Federal funds in blue. The Federal Reserve paused during the last interest rate decision at the 5.25% level. GDP near record highs. Now, there's a lot that goes into the story about the Federal Reserve and, the purpose to raise interest rates. Typically, it occurs under periods of time that we have great economic growth. I don't know that we have that now, but the Federal Reserve does have a tremendous inflation issue, and I think that's really the reason why they've been compelled to continue to raise rates, and probably, if I were to guess, why they may raise rates during the next meeting. Now GDP continues to rise as well, but I think we'll see in other numbers coming forward that maybe it's not all a rosy picture. The jobs numbers, the next jobs numbers, I think are going to tell a very important story. This is a GDP recession index versus the S&P 500. And what we're looking for is this level during the periods of time of a recession to cross above 30. We're currently, maybe the 10 level. To cross above 30, that marks the beginning of a recession. And then when it crosses back below 60, that marks the end of the recession. Well, we're nowhere near that now. We're not at zero either, but we're relatively in a very, very good position as far as that's concerned. So, for all intents and purposes, the GDP, the PCE, the durable goods, all these numbers give us something to be hopeful for. Well, with all that said, taking a look at the markets, let's see if the stock market agrees with us. The black dotted line is the S&P 500, and we have a number of different moving averages. The red line is a 10 simple moving average, purple is a 20, the 50 simple moving average is yellow, the light blue is the 90, and the green is the 200. There's nothing special about the moving averages. But when we see a strong trending market, we should see the moving averages in order, which means the shortest term moving average should be at the top. The longest term moving average should be at the bottom. Well, that's exactly what we see right now. The 10, the 20, the 50, the 90, and the 200. All these moving averages really came into order around April of this year, and that's when the S&P 500 was approximately 4150, and that was not too long ago, actually. May 1st. Well, fast forward now, beginning of July, we're at 4450. That's a huge move for the S&P 500. Now, of course, this can't be a trading signal unto itself, but certainly it does give us a lot of confidence that when you see all the moving averages in order, which is the first time we've seen it, going back quite a while, this is an indication of a very strong market. There's no telling how long the market will last in this particular strong uptrending market. But the numbers look good. Of course, it does indicate the Federal Reserve is going to raise interest rate, but for some reason the market seems to be more focused on the good numbers than on the implications for higher interest rates. It's almost as if the markets don't care about high interest rates. Well, we know they do. This is a 90-day past performance of the S&P 500 when it's above its own respective moving averages. So, over the past 90 days, historically speaking, when the S&P 500 is above its 10 simple moving average, it averages over 90 days, a quarter of a year, around 4.6%. Well, if you extrapolate that out for the year, 4.6% for 90 days, that brings us around 18-19% return on investment for the year. That's pretty good. Now, of course, the more that the market is above its longer term moving averages, for example, the 200 simple moving average, the market tends to return around a 6.1% return on investment every 90 days. That's 24% a year. Point being is that it's much more significant when the market is above its longer term moving averages than the short ones. This is what the market looks like long term. S&P 500 in black, the 90 is a blue line, the 200 is a green line, and when the blue is above the green, the 90 and the 200 it's a very commonly tracked combination of moving averages. And we can see going back in time, if we were to buy the S&P 500, for example, June 13th, 2016, the S&P 500 was at 2080, about 2100. That's when the blue crossed above the green, the 90 above the 200. Well, buying the S&P 500 at 2100, the 90 did not cross below until January of 2019, and the S&P 500 went from 2000 to 2900. That's about, 45% return in, maybe a couple years, 2 years, a year and a half. Again, the 90 crossed above the 200 right around 2020, about 2020, late 2020. S&P 500 at that time was 3,300. August, September 2020, 3,300 S&P went up to 4,700. That's about 50% on that return on investment. Point being is that when the 90 crosses above the 200, it's not certainly a guarantee it's going to happen like it did in the past, but it's a very strong signal, and it can mark the beginning of a very strong long-term trend. We don't know what's going to happen now, but I think it's important to recognize, number one, fundamental analysis. What do the numbers tell us? What's the state of the economy? What is the Federal Reserve watching? What are they most likely to do? Well, we know the numbers are strong. Inflation is waning, but growth is very strong. It's probably enough to give the Fed more reason to raise rates. But despite that, stocks are strong. We'll talk about this again in the future, but not all stocks are strong. I know the S&P 500 looks good on the surface, but the NASDAQ actually looks a lot better. And it really is a stock picker's market. So we're going to try to, zoom in on that in the near-term future and identify really where the true strength is in the market. We'll be back, and we'll definitely update you with any significant changes, either on a fundamental or a technical side, to be sure, because there's a lot going on. We hope this has been helpful. We look forward to seeing you back soon.